Welcome back, everyone. We know the currency markets are in crisis as countries all over the world try to help their own exporters and gain a competitive advantage over their rivals. So the question is, how will these currency wars play out? And where should you as an investor position your money? To help us answer those questions, Brian Rich is back with us from North Florida. He, of course, is a currency specialist for Weiss Research and the editor of the World Currency Alert. Also joining us on Skype is Chuck Butler. He's coming at us from St. Louis, Missouri. He is the president of Everbank World Markets and the editor of the widely read currency newsletter, The Daily Finnig. Chuck, I'd like to start with you. Chuck, of course, as you well know, last weekend's G20 meeting, ministers, the finance ministers, all came together. They agreed last weekend to avoid any competitive devaluations. Do you think that's something that's actually going to hold up?
Well, you know, I do, because I think that this currency war thing, I'm really not a true believer of it so far. I think there's a lot of little things that have kind of led people to believe that this could be what's going on in the future, but there's not really any hard evidence, in my opinion. I've been a long believer of trends in currencies, and these trends normally play out over these periods of time. And you can see these times where it looks like countries are going to go down this path, but you know, you also, on the other hand, see countries raising their interest rates and doing things that would make their currency stronger, not debase them. So to me, it's a question of whether it's really a currency war or just activity in the currency markets right now.
Brian, do you agree?
I would agree with Chuck. I don't think that there's a full-blown currency war by any means, even any more dramatic than it was 6, 8, 12 months ago, almost 2 years ago to this point, when you consider what China's been doing with their currency. But I think global officials understand the slippery slope that we're on and where this heads to, and that's the I think that's the real backdrop here. We need to pay attention to where this could head. And that's why I think the G20 got together and thought this was such a critical issue to address. Although I think formally, at least publicly, they haven't made any drastic steps to alter the course of currencies for the moment.
Chuck, Treasury Secretary Tim Geithner reiterated his support recently for a strong dollar policy. Do you believe him?
No, I never have. I didn't believe him, nor his predecessor, Hank Paulson, or his predecessor, O'Neill. All of them have basically said that they believed in a strong dollar. But at the same time, on the other side of the table, they would be yelling at China to get their currency stronger against the dollar, which would mean that the dollar would be getting weaker.
Brian, what's your take on the strong dollar policy?
You know, I don't think anyone wants a strong currency in this environment. So do I think the U.S. wants a strong currency? No, I just don't think they have the luxury to devalue their currency. You know, I think everyone thinks this is a big dollar issue and that the U.S. is systematically devaluing the dollar at the expense of the rest of the world. I just don't think that's the case. I don't think, if you look at many of the policy responses over the past 2 years, you can see very clearly that the U.S. is very in tune with the interconnectedness of the world.
Right. It seems to me that you're saying that the dollar's weakness is kind of a side effect of sorts of the Fed's policies. Is that the case?
Yeah, I do. I mean, I think it's going to be fairly short term because I think, as opposed to what the sort of the general sentiment is at the moment, this is not about interest rates. It's not about inflation even at the moment. It's about growth and the lack of inflation, the lack of demand, the lack of price pressures.
Yes, the current weakness of the dollar has been really just a direct result of where the markets believe that what the Fed is going to do in their next meeting, which is the quantitative easing. But the overall weakness of the dollar for the last 8 years hasn't had anything to do with that. It really is one of those things where we've seen that the U.S. current account deficit has gotten so high, the budget deficit and so on, to where we're running at about 4.5% of GDP. Historically, whenever countries ran into that 4.5% of debt to GDP, they had currency problems, and we ran into it in 2002, and we've been having it having that same problem ever since. So you see periods of time when the dollar can get strong, but eventually it comes back to the underlying trend of a weak dollar.
Chuck, I want to look to the future a little bit here. What's your outlook for the dollar, the Chinese yuan, and any other currencies that you really stand out going forward here?
Well, I think the currencies that stand out are the ones that have good fiscal positions, like Norway, China. You've got currencies that have nice commodity resources, like Australia and Canada. Those would all be currencies that probably should be looked at. But the currency that I think that most people should be looking at the most is the Chinese renminbi. I call it the renminbi. It's the yuan. It's one and the same. It's like the buck and the dollar. The renminbi has been the most undervalued currency for some time now. And while I see China moving up or stepping up their appreciation of the currency, I think it's going to take some time. So, from July of 2005 up to the financial meltdown in 2008, the renminbi had gained about 20% against the dollar. But then in 2008, with everything else going on, the Chinese pretty much held it steady until just a couple months ago, and now it's gained back about 2.5%. So I think we'll see it go on a slow appreciation, but an appreciation nonetheless. So that is one currency that I think people looking forward way out into the next 2 or 3 years would want to look to buy.
I don't see China making any material concessions. I see them continuing to do what they've done. In June, they announced that they would be breaking the peg against the dollar, essentially, which we've seen again since the crisis broke out in 2008, that they would be managing the currency against a basket of currencies. So one would have thought, with a weakness in the dollar in the past 5 months, we would have seen quite a bit more appreciation out of the yuan. However, it's not really in China's best interest to do that. It's in their best interest to keep it closely aligned with the dollar, which we've seen. It's only appreciated to the tune of around 2.5%. Meanwhile, the euro's risen 20%. A lot of its key trading competitors like Brazil, South Korea, Japan, all of these currencies have way outpaced the strength of the yuan. And, I don't see any reason to believe that that's going to change.
Brian, give me some safe spots here. Where would you be telling investors to put their money?
Well, as I said earlier, I think we may see a coordinated response to weaken the yen. So I think you can short the yen, perhaps even look into the ultra ProShares ultra short yen ETF. The symbol there is YCS. And certainly, given what it on the surface looks like the G20 wants, you could be buying the currencies of these countries that are running current account surpluses and trade surpluses. But I think you have to be very careful and watch these very closely with tight stops, because the risk associated with those trades can be quite great if we do see other shocks in the global economy.
Chuck, give me some specifics here. How would you recommend investors play the currency markets?
When you're dealing with currencies, there are several different ways to do this. You can buy currency ETFs, and you can get those through just about any brokerage house. You can buy foreign stocks and bonds that are bought in the local currencies, or you can do currency deposits in banks. These are all things that are available to investors if they want to use currencies as a way to diversify their investment portfolios.
That's all the time we have. Chuck Butler, Brian Rich, thank you both for being here.
Thank you, Jamie.
Also, thanks to Jen Amos, Rudy Martin, and Tony Sagami. If you have a question for any of this week's guests or a suggestion for a topic that you'd like us to cover, just email us at weissmoneynetwork@weissinc.com. Coming up next week, we'll examine what the third quarter earnings season taught us about the health of the U.S. economy, and we'll discuss how specific industries and companies are doing in the current quarter. If you're looking for stock picks that are likely to outperform the overall market, you won't want to miss it. Thanks for watching Money and Markets. I'm Jamie Holmes, and now, here's Martin Weiss.
Thank you, Jamie. Now, if you once thought that the ups and downs in world currencies didn't matter much, you probably have been dissuaded of that notion by recent events and by the insightful comments of our experts today. But let's step back from the day-to-day for a moment to get our arms around what's really driving these markets, you have two major players in the world arena: investors and government leaders. Investors want profits, and they'll go to the far corners of the world to get them. The leaders want votes, and to get votes, they're doing everything in their power to create or keep jobs with the one source of revenues that's up for grabs in huge amounts all over the world, and that's export revenues. Selling as much as you can in as many different countries as you can, especially those that have the biggest consumer markets or the fastest growing consumer markets. Now, if you're producing goods for your people anyhow, and you can get some extra sales from abroad, well, that's pure gravy. Or if your entire economy is geared up for exports and a competitor from the other side of the world cuts into your export market, hey, that's even more reason to make this a priority. So now, how do you compete in this global market? Well, if your country has hardworking, efficient people and technology, then your country is like Apple or Google. You stay on the cutting edge, you develop the best product you possibly can, and that's how you get a big share of this huge global market. But if you don't have that product power, and you don't have that technology, you can't compete on a level playing field, then you're more like Walmart or Target. The only way you can get more customers is by announcing a store-wide sale, slashing the price on all your inventory by 10%, 20%, 30% or more. And that's the tactic that countries use by devaluing their currency. They're declaring a countrywide sale. Trouble is, once one or two big chain stores, big countries, start a price war, then everyone has to join in the fray. Once the US and China are doing it, almost every country in the world has to do it too, either to knock their currencies down, or as in the case of Brazil and others, to at least stop their currencies from going up so fast. So let me put all this in a nutshell. Currency wars are nothing more than price wars. But in this kind of a price war, it's a little bit different. While the paper money goes down in value, gold, commodities, and the countries that produce them go up in value. And that's where investors will rush to get their profits. Now, bear in mind that this is not a one-way street. It's subject to sharp intermediate reversals. And at some point down the road, it could even turn into a new bubble. So no matter how strong markets may appear, always remember to keep most of your money safe. This is Martin Weiss with Money and Markets. We'll see you here again next week. Thank you.